The bubble is starting to pop. I'm your host, Steven Van Metre, and thanks for joining me today. And we talked about this last year and how the housing bubble was set to pop, but it got delayed due to the pandemic. And now we're seeing early signs that the bubble is about to burst. Let's head over to Bloomberg, where we kick this story off, who headlines that U.S. foreclosure surged in January after an end of pandemic freeze. And foreclosure filings such as default notices, scheduled auctions, or bank repossessions jumped 29% from a month earlier and more than double compared to January 2021, the report said. Lenders repossessed over 4,700 properties in the month and started the process on another 11,800 homes. And it's very important to keep these numbers in context, according to Realty Track, because the foreclosure completions are still far below normal levels, less than half as many in January 2020 before the pandemic was declared. And possibly what we're seeing is just a delay as more people head to the foreclosure line. Let's keep going because you can see it's trouble ahead in this graph from Bloomberg. The states that saw the greatest number of foreclosure starts in January were some of the places that saw the biggest appreciation of home prices: Florida, California, and Texas, leading the pack ahead of Illinois and Ohio. And he said that after the end of the moratorium, as I just suggested, we're likely to continue seeing large year-over-year percentage increases for the rest of the year, suggesting that this foreclosure bubble is just about to pop. And what's interesting is what we're seeing right now is speculators and investors dumping bonds and driving rates up. And that's actually a recipe for lower rates and adds to the narrative that the bubble is going to burst. Let's check this out as we head back over to the St. Louis Fed database, where we have the 30-year fixed rate mortgages, which are backed up all the way to 3.69% as yields have gone up on real estate. And what's interesting here is I want you to notice that you can see in 2013 when rates rose and mortgage rates rose, what happened? They peaked and came back down. You see here late 2016, they surged higher and then came back down. And then 2018, they rose and came all the way down to new all-time lows in 2021. And what I want you to understand here is that higher rates, and this is something that most people get wrong, the higher rates actually have to be validated by lending demand. So what you see with speculators is they will short bonds, they will short mortgage bonds in this case, drive rates up, because they're hoping there's demand there. And if there is demand, well, that will take rates even higher and they can profit on that exchange. But what happens is they drive rates up, and what happens in most cases, well, demand goes away. And how do we know that? Because we can look and see where people had been buying and refining at what rates, because they're highly unlikely to do so at higher rates. So let's go back. And then what do we note? That starting in 2019, as you can see rates falling, refinances and lending started to pick up and then surged in 2020 through 2021, meaning most people have already refied at current rates. So their incentive to refi is pretty low. And January is typically a month when foreclosures pick up after a holiday slowdown, and this year's rise was amplified by the end of the pandemic freeze. But homeowners have also benefited from record surge in prices over the last 2 years, which has rescued more than 1 million borrowers from underwater mortgages and made them less vulnerable to foreclosure. And here you can see from the investing.com website, the U.S. Mortgage Refinance Index. And just kind of as I mentioned, you can see starting in 2019, refinances started to rise and surge higher in 2020, in early 2020, and has now been coming down. With the exception of last week, we saw a bit of a pop. And so what's happening here is there are people that are adjusting to inflation by taking equity out, but a lot of people are saying, I'm not going to touch my equity. I'm not going to refi at a higher rate. And what happens when you do see consumer prices rise is people will try to adjust to that by using their credit cards, perhaps drawing from their home equity and hoping that their pay will eventually outpace inflation, and they use this as a buffer. But with many people closer to retirement now than ever, the demand for refinancing isn't going to be there. And that's how you know that rates can only go so high, because without demand, well, rates have to go lower, and that's why that happens. Let's continue on with this story. As we see, as well as a moratorium on foreclosures, the government's COVID aid program also included measures to help struggling homeowners delay their loan payments. And while now those payments are coming back, an estimated 7.1 million borrowers, 14% of all mortgage holders, entered into forbearance during the pandemic, although more than 2/3 of them had exited by March 2021, which is excellent. But here we are almost a year later. And what does that mean? That perhaps that some of those are going to be back, and that is going to be a huge problem, suggesting that we're at the early stages of the bubble, and particularly due to inflation. Now, if you're concerned about how your portfolio will behave if we go through another financial crisis, well, be sure to check out Portfolio Shield. There's a link in the corner of the description below. You'll be glad you did. Let's continue on with the story, because what we see here from the Wall Street Journal is higher inflation is probably costing you $276 a month. And who is feeling the price squeeze the most? Well, millennials, Latinos, and the middle class are at the top of the list. And this is why, part of the reason why people can't afford their rent payments and their housing payments. A lot of people are hurting because of high inflation. $276 a month, that's a big burden, according to the senior economist at Moody's Analytics, who conducted the analysis. It really hammers home to the point, what is the cost of inflation? Well, it's a lot. And the figure was made up by comparing what the average household spent under a 7.5 inflation versus the amount it would have spent when inflation was 2.1, the average in 2018 and 2019. And research shows that inflation is also squeezing some groups on average more than others. The Consumer Price Index reflects a change in prices for the average basket of spending, but people's spending baskets vary based on who they are, which influences to some degree their daily needs, where they live, and how they get place to place. A study by Wells Fargo and Company economists broke out the impact and fine demographic details based on December 2021 inflation rates. It uses spending baskets for 2019 and 2020, more recent than used for the CPI, and found that inflation is 6.5% in December, down from the 7% reported by the Labor Department using a spending basket from the previous 2 years. And the calculations don't necessarily capture the whole picture of each demographic group's financial realities, and this is where we get into the problem and why the housing bubble is set to burst. The economist noted that the way the government measures housing costs mean they're likely overstated the cost burden for homeowners and understated it for renters. And lower earning households, this is a big issue, devote the biggest share of their budgets to rent, which means they probably are experiencing much higher inflation. And that's where we see the problem is low income households can't afford the payments, plus higher energy costs, plus higher food costs, and something has to give. And one of the easiest things you can do, rather than give up your car, which you need to go to work, or food, which you need to be, have the energy to go to work, is you can go into foreclosure and perhaps drag the process out. Maybe you can come out ahead, but you can stay in your home for a lot longer than most people realize. And that's why you see people that are financially burdened stop paying on their house and headed to foreclosure. But let's keep going with the story, because it hasn't resulted in much trouble making payments, except for those under 30. Delinquency rates along this group rose in the fourth quarter, suggesting there may be challenges brewing for some younger borrowers. Wow, that's wild. And here we can see, as the Wall Street Journal continues, why high gasoline prices could stick around for a while. And again, this will continue to push budgets for most people as demand for oil is outstripping supply with little promise of relief ahead. Americans are paying about twice as much for gasoline now as they were in early COVID-19 pandemic, and the high price for fuel is costing consumers away from gas pump two, contributing decades high inflation on a range of goods and services. Again, all adding to the narrative of why high inflation leads to a recession. Of course, recessions are the best way to cure high inflation. Let's keep going, because it's not just at the gas pump, as you know, it's also at the grocery store. No more steak, as Bloomberg. American consumers try to beat inflation. When prices on food and other basic goods go up, people adapt their spending. And here you can see grocery inflation is at the highest level in 15 years. And with people needing to pay rent, energy, and food, well, their budgets are strapped, leaving them little money for anything else. And while consumers are spending more on their groceries, they're cutting back on what they regard as non-essential. That's different for each family, as some could be snacks, for others fresh flowers or items such as bottled water that can easily be substituted. And these are just the first indications of consumers cutting back, trading down, and shopping around. And if they turn headlong rush into frugality, companies' future earnings reports, which won't be good for stocks, won't be as positive. So what you're seeing here is, due to high inflation, what we're seeing is now the beginning of this housing bubble starting to burst. And if inflation does persist higher, which it is likely for several more months before it gets any reprieve, well, by that point, we might be back into a full-blown housing crisis, particularly as the Fed tightens. I'm Steve Van Metre. Thanks for watching. Thanks for supporting the show. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. So not to be construed as recreational or solicitation, buy or selling a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.